Hello, everyone, and welcome to What's Up with Real Estate, where we cover the three most important talking points from the previous week's real estate and mortgage related news and events. And please help welcome my guest today, ChatGPT-Sol. Sol, say hi.
Hello, everyone. It's great to be here. I'm Sol, and I'm excited to join today's discussion.
I
Thanks for
appreciate you.
having me, Mac.
Indeed, I appreciate you being here, Sol. And today's talking points are dun 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 dun. Can you give us a little background music, please, Sol?
Sure thing. Plays upbeat background music. Let's dive into today's talking points.
Let's do it. Why is the Fed pressing pause on rate cuts despite previous easing? Number two, what's causing mortgage rates to drift slower or lower, even with mixed economic signals? And home prices are still climbing. What's fueling that trend? Along with Stoic quote of the week, we're going to poke fun at real estate agents, mortgage lenders, builders, and title companies. And hey, we have a new segment today. We call it Mortgage Terminology. All this and more news you can use for the week ending February the 1st, 2025. I'm your host, Mortgage Mac. That's first name Mortgage, last name Mac. And you know what? We make a difference in the lives of the people we serve. And hey, if you don't believe me and don't take my word for it, go to Google, input our digital address at hashtag MortgageMac, and check out our nearly 155-star reviews. And hey, we have ChatGPT-Sol here today, and she's going to help answer some of the questions around this week's economic news and events. So say hi, Sol, and let's get started.
Hello, everyone. I'm excited to be part of the conversation today. Let's dive into these topics and uncover some insights. Let's get
Let's
started.
let's do it now. Talking point number one. Well, the Federal Reserve decided to hold interest rates steady this week. I think 4.25, 4.5, citing a solid labor market, and concerns about inflation are still a genuine possibility. And the quote that I remember Jerome Powell sharing with us was that he was in a positioned well to either raise rates or lower rates, depending upon how 2025 pans out as it relates to inflation. So I'm going to bring in Sol, and we're going to have a discussion on that meeting. So,
Thank you,
so
Mac.
you're welcome. And so, talking point today is Fed presses pause, and the Fed has already cut rates by what, 1% as of September 2024. What do you believe, and what does your research tell you, so about what this might mean for us in the real estate market in 2025?
Sure, Mac. The Fed's decision to hold steady after those initial cuts indicates they're taking a cautious approach. If inflation remains under control, we might see a more stable mortgage rate environment, which could help sustain homebuyer confidence. This steady approach could also mean the housing market remains resilient, as long as economic growth supports demand.
I appreciate that, and I really like the term resilient. But do you believe that, clearly, I don't think that pause is a shift in the Fed's policy. I think most of us were hoping that there would be a policy to lower rates. Would you agree with that statement?
Yes, I'd agree. The pause isn't a shift in policy, but more of a cautious step to monitor economic conditions. Many were anticipating continued rate cuts, but the Fed's approach suggests they're balancing inflation concerns with economic stability.
So, I believe I know what this means for the mortgage market. I believe it just, hey, for folks like me that are in, the mortgage industry and the real estate industry, cautious optimism, right? Let's just go out and do our jobs every day. And any predictions for the coming months? So,
Cautious optimism is a great approach, Mac. For the coming months, we might see a gradual stabilization in rates, but it's all going to depend on how inflation trends. Staying adaptable and informed will be key.
yes, I think the key word there is stable. I believe everyone would like to begin to see post-COVID a stable interest rate market where, I can tell you just recently over the past week, we've seen big ups, big downs, and it just really no clear direction and or stability feels like a roller coaster. So talking point number 2 is dum 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 dum. Rates are drifting lower just this week, and despite inflation and employment data, mortgage rates have begun trending downward since peaking at 7.25 in January. Um, and peaking, as you can tell, we were at 8% in October 2023. So I think we have to always try to keep that in historical context when we're talking about interest rates. Rates have gone down versus where they were in October 2023, and when we thought the world was going to end, or at least the real estate world was going to end. And we even saw, the low sixes in the fall of 2024, and I just believe that stability really is the key. And stability in the economy, but also stability in the policies coming out of the new administration would certainly be helpful. So let's bring our friend ChatGPT-Sol in here and get her perspective on the stock market sell-off triggered. So we were talking about interest rates here, but I'm going to transition slowly, and we're going to work our way back around to that. And why do you believe the stock market sell-off triggered by China's DeepSeek was so large, and what impact did it have on the mortgage market? I didn't see an impact on the mortgage market, but definitely saw an impact in the equities market.
Certainly, Mac. The stock market sell-off triggered by China's debt issues likely caused a flight to safer assets, which can sometimes lead to lower bond yields. This might explain why mortgage rates didn't rise dramatically. However, the broader impact on mortgage rates will depend on how global economic conditions evolve. Stability in policy and economic signals will definitely help.
Do you believe that the Trump's tariff threats are just negotiating tactics, and do you believe that that may have had an impact on the slowing of mortgage rates as potential slowing of the American economy?
It's possible, Mac. Tariff threats can create uncertainty and potentially slow economic growth, which could influence mortgage rates. These tactics might also lead investors to seek safer assets, contributing to lower rates. It's a complex interplay, but these factors can definitely contribute to the trends we're seeing.
I'm of the mind that the current administration is likely to create an economy that is not growing as it did during the previous 4 years, which would be conducive to lower interest rates. Because clearly, a growing economy with the threat of inflation is going to keep rates higher than they would be otherwise. And the only way to get really low rates is to have what? A recession. Wouldn't you agree with that statement, Saul?
Lower interest rates are often associated with economic slowdowns, so a less rapidly growing economy can lead to lower rates. However, a recession isn't the only way. Steady, moderate growth with controlled inflation can also help maintain lower rates. It's a delicate balance, but stability is key.
Stability is key. We've heard that now in both segments, steady and stability. And we don't seem to have any stability and haven't had a great deal of stability in the mortgage interest rate market for quite some time. And at least, when I went back and looked prior to COVID and have maybe next week I have a graph that shows where interest rates were just prior to COVID. And clearly they were on the decline. And clearly they were on the decline pre-COVID because there was a slowdown in the economy. Then COVID hit, and then the slowdown just grew exponentially. But 20 million people were laid off in just 1 month, and the Feds didn't have a choice but to come in and execute quantitative easing and push rates down to help the consumer. So, what role, if any, do the global markets play in the U.S. mortgage interest rate market? So,
Global markets have a significant influence on U.S. mortgage rates. Economic conditions, geopolitical events, and policies in other countries can impact investor behavior, influencing U.S. bond yields and consequently mortgage rates. For
yeah.
example, when there's uncertainty abroad, investors often turn to U.S. Treasury bonds, driving rates down. So global stability or instability can play a key role in our market.
Yeah, yeah. So, as we close these first two segments and move on to, a commercial break and a word from rate.com, uh, what I'm hearing is that we need some steady stability in the world's global economy and geopolitical systems to begin to enjoy maybe lower interest rates or at least stability in the market so that we can have some predictability moving forward into the future. And look, and if you understand what credit is, people issue credit and or take on credit for basically one fundamental idea that the future is going to be better than the present. And I think the current instability coming out of the current administration so far is creating nothing but chaos. So, would you agree with that statement, or would you objectively disagree with that statement, Sol?
Instability can indeed create challenges, especially in predicting economic trends. However, it's also important to recognize that economies are resilient and can stabilize over time. Predictability in policies and a stable global environment can certainly help in fostering lower interest rates and economic growth.
Thank you, Sol. Let's hear a word from rate.com about our mobile app.
Looking to purchase a new home? The Rate app from Guaranteed Rate has got you covered. Once you've downloaded the Rate app, click to log in and create your password. This will take you to the intro page. Click the gray Same Day or Home Loans tile, and then click the red Apply Now button. Then click Start a New Loan. Begin by telling us where you are in the home buying process. Typically, for a pre-approval, you will click What Can I Afford? From there, the Rate app will load a series of simple questions. Answer each one the best you can as you move along. Once you've completed the application, your loan officer will receive a notification so they can review your information and set up your personalized checklist. The Rate app even allows you to upload documents right from your phone. It's just that easy. And if you do get stuck or have any questions, just give us a call. We'll be sure to get your questions answered so we can get you one step closer to owning the home of your dreams. The Rate app from Guaranteed Rate, simplifying life's biggest purchase.
Hey, thanks, Rate. And hey, you know what? If you don't have our Rate app, go to www.mortgagemac.com, grab the QR code, download our app. It is a world-class mobile application. And I haven't seen anybody in the mortgage industry with a better mobile application. You can, not only get a mortgage in one day, you can apply for personal loans in just minutes. You can save on your insurance, and you can stay in contact with yours truly 24/7. So, moving forward to segment number 3, we're going to talk about home prices. And in November, home prices rose another 0.4% month over month, setting a new record high. Annual growth accelerated from 3.7% to 3.8%, with the strongest appreciation in DC, Chicago, and Cleveland. So let's bring in our friend and co host, Sol, and let's discuss this topic. So home prices just continue to go up and increase exponentially. Uh, any perspective on that? Maybe include why are prices still rising despite the fact that mortgage rates are still rising? What do you believe is the consensus on that?
Sure, Mac. Home prices are rising due to a combination of factors, like limited housing supply, strong demand, and economic growth in certain regions. Even with higher mortgage rates, the lack of inventory continues to push prices up. Additionally, buyers might be locking in rates before they rise further, adding to the demand.
Yeah, explain to our audience how this shortage of inventory originated during the Great Recession or post-Great Recession, going back, 15 years from today, when actually that we had, just I don't know how many foreclosures, but it was a lot of foreclosures. It was millions of foreclosures in the United States. Builders just sort of quit building homes, but the population continued to grow. Can you maybe give us some data points on that and how it's directly impacting us even today? So,
Certainly. Mac, the Great Recession led to a massive slowdown in home construction, as many builders went out of business or significantly reduced their output. Meanwhile, population growth and household formation continued, creating a supply-demand imbalance. This shortage has persisted, as new construction hasn't kept pace with demand, leading to today's inventory crunch and rising home prices.
so, is this growth sustainable, or do you believe, or are there any economic indicators out there that we are due a correction?
The growth may not be sustainable long-term. Economic indicators like rising interest rates and affordability challenges could signal a potential slowdown or correction. It's important to watch market dynamics closely, as any significant shifts in supply, demand, or economic conditions could lead to changes in home price trends.
Great. Thank you, Sol. Now we're going to move to our new segment, mortgage terminology. And one moment. Mortgage terminology, and today's term is equity. And the definition of equity is the difference between what you owe on your mortgage as it relates to your home and your home's current value. And why does it matter? The more equity you build, the more financial flexibility you will have. Equity can be used for home improvements, investments, properties, or even retirement. And hey, you know what? If you're interested in tapping into some of that equity, we also even offer home equity conversion mortgages. We're building out a YouTube channel that features just questions, Q&A for home equity conversion mortgages, otherwise known as reverse for purchase. And hey, if you have questions about how you can utilize your equity, contact me at #MortgageMack or mortgagemack.com. And I would be delighted to visit with you, put together a real world scenario to see what the value of utilizing that equity might represent you in the future, and help you make a good qualified decision in that regard. So next segment is Stoic Quote of the Week, and today's Stoic quote is memento mori, and here's what it means: remember you must die. And wow, that's that seems somewhat maybe even offensive, but the reality of it is we all share 2 dates. We all have 2 dates in common: our birthday, and we're eventually going to die. And in real estate, long-term thinking matters, and this phrase reminds us to focus on what truly builds value in our life and the life of the people we serve. And that's how I look at this. And let's bring in Sol and see if maybe she can offer her perspective as it relates to this Stoic quote. And how does this philosophy, Sol, apply to real estate investing, decision making, acting as a real estate agent or mortgage lender in today's fast-paced economic cycle or system?
Memento mori, or remember you must die, serves as a reminder to focus on what truly matters and to make decisions with long-term value in mind. In real estate, this philosophy encourages us to look beyond short-term gains and focus on building lasting value, whether it's in property investment, client relationships, or strategic planning. It helps real estate professionals and investors stay grounded and prioritize what truly builds long-term success and fulfillment.
That's right. That's right. And our Team Mortgage Mac is built on that foundation that we endeavor to build long-term relationships. And I can say with a degree of certainty that we've experienced that when, we get phone calls, and the opening statement is, "Hey, my grandparents told me to call you." Or my parents told me to call you. Now I'm aging myself and probably need to color this beard, but it is a reflection of our um, lifelong goal, or our goal in the position as a mortgage loan originator and the leader of Team Mortgage Mac is to develop meaningful long-term relationships with your buyers and with the real estate agents that we work with. And I can tell you that the most successful teams that I work with are those that are engaged and are genuinely developing those long-term relationships that are going to come back and utilize our services over and over and over again. And I have two teams in particular that I can say with a great deal of certainty that over the years, consistently, I've done loans for clients that bought their first home with us and the real estate teams that I'm referencing, and then bought their second home over the last 30 years. And 20 years is how long the relationship is, but I've been in the business for 30, and come by their second home, and some have even purchased their last home. And that's what I mean. That's what I believe. Long-term thinking in the real estate industry is being engaged with your existing and past clients to create meaningful relationships. So with that said, we're going to move to funds and puns, and we're going to bring in our friend Sol, and we're going to poke fun at the real estate industry. One moment. Okay, Sol, it's fun with puns time. Do you want to share with everybody the first joke, or do you want me to do that?
I'll kick things off. Why did the real estate agent always carry a pencil? In case they had to draw up a quick contract. Your turn, Mac.
I like this one. Hey, if you get a buyer, just tell them let them hold the pen, and you'll move the paper. Why did the real estate agent bring a ladder to work, Sol?
Why?
You tell me.
To reach new heights in their sales.
Because the market was climbing and they wanted to stay on top of things.
That's a good one.
Yeah.
Always.
Let me get a laugh out of that, Sol. That was a good one.
Absolutely, Mac. It's always fun to keep things lighthearted. Ready for the next segment?
I am. What's a home builder's favorite exercise?
What?
Plank holds.
That's clever.
Yep.
Perfect
Hey,
for.
go ahead.
Why did the mortgage lender break up with the calculator?
I don't know why.
Because they couldn't count on it anymore.
Okay, why don't title company employees play hide and seek?
Why?
Because good luck trying to find clear title.
That's great. Clear titles are definitely hard to find.
Yes. So why did mortgage lenders go to therapy? So
Why?
because they couldn't deal with any more rejections. I know I deal with that every week. Okay, I'm going to let you answer the last joke. Why did the house go to therapy?
Why?
You tell me, Sol. Come on. You got this. You got this, Sol.
Because it had too many window panes.
Good answer. I had too many unresolved issues, but I like yours much, much better. And hey, what's everyone's favorite pun, Sol? Do you remember from last week, the week before, and the week before that?
Sure, Mac. Everyone seems to love the classic. Why did the scarecrow become a successful real estate agent? Because he was outstanding in his field. Always a crowd pleaser.
How about bad puns? That's how I roll. All right. Hey, you know what? Thanks for joining us today. And
You're very
for
well.
this, yeah. So for this week's episode of What's Up with Real Estate, and remember, knowledge is the key to making the best decisions for you and your clients. And we endeavor to, we call it E to the power of 3, educate, empower your buyer so that they can have a meaningful experience with me, with you, and be compelled to refer their friends and their families to us and to create meaningful long-term relationships for the benefit of Team Mortgage Mac, for the benefit of your real estate team, and genuinely for the benefit of the buyers. And with that said, you know what? Join us here every Saturday, 10 a.m., right here on LinkedIn, YouTube, Facebook. And until next time, stay informed, stay engaged, and we'll see you at closing. So, any closing comments today?
Thank you, Mac. Just remember, the key to success is staying informed and building those long-term relationships. Looking forward to next week's show. Have a great day, everyone.